The stock market is behaving in a pretty crazy kind of way. Let's see if Roger Montgomery from Montgomery Investment Management can make sense of it all and slip us into some interesting investments. How are you, mate?
I'm well, Peter. I was interested in hearing Tony's thoughts.
Yeah, he's been a great performer over the years, Tony.
I like him a lot.
Yeah. Do you like Sydney Airport?
I actually think as a result of $12 trillion of quantitative easing and 600 interest rate cuts, this is about as good as it's going to get for Sydney airports and the major infrastructure stocks, because they are the lowest risk investments, and they're the things that have been bid up for the longest. And if you look at their prices, you'll see that all around the world these very high quality assets are trading at extraordinary multiples. Now, if you believe that the earnings are going to flow, they'll stay supported for a while, but as the higher risk investments start to unwind and people move back towards cash eventually, they'll be hit as well. So I'm less sanguine about infrastructure than Tony.
What about the dividend aspect of those sort of companies? Because the business is pretty consistent.
Yeah, it is.
And they'll probably get the
issue is
correct, won't they?
Yeah, but the issue is, what do you pay for those dividends? And because of the factors that I've just mentioned, people are paying more for those dividends and paying more for every dollar of income than they've ever paid before.
Is that partly related to the fact that interest rates are negative around the world?
So, well, not all around the world, but they are negative, and they are very, very low. And as I mentioned a moment ago, we've had
these sort of investments look so good.
Since the GFC, 600 interest rate cuts around the world, and we're still just plodding along.
Who counted that up?
Yeah, somebody. Someone had a bit more time.
Okay.
So it's actually slightly more than 600. But the point I'd like to make is that we really are at an inflection point for markets. It is rather scary, and I can't think of another adjective for it, but that's it. And I say that because I'm very concerned that we're about to see some sort of credit event.
E.g.?
I'll give you some stats. So between now and 2020, which is only 4 years away, we're going to see in the United States alone something like $947 billion of debt be refinanced, and that's junk bond debt. Now, in 2020 alone, it's $400 billion. It is the most
do you think
ever.
It'll have to be refinanced at higher levels, or it won't get refinanced?
It won't get refinanced at all. So, for example, most of the stress at the moment, well, we're already seeing it. So in 2015, we saw 105 defaults in the United States, and that was double the year prior. Why is this happening? It's happening because commodity prices, it's all in oil and gas at the moment, all of the stress, but Moody's is concerned when they look at their stress index, they are concerned that it's starting to spread wider, and where is all the debt outside of oil and gas? Believe it or not, telecommunications, mostly in telecommunications. And that's interesting because what we've seen, for example, in the high-tech space, is for the first time since the bottom of the GFC, we've gone an entire quarter where we've seen no technology floats at all in the United States. You look at Etsy, which is that online sort of craft marketplace, it's down 45% since the IPO. There's a whole bunch of tech floats now that are lower than they listed only a few months ago. In fact, the only one that I saw that listed in the last 6 months that is above its IPO price is Atlassian, and it's only 12% above. So we're seeing a bit of a desert in terms of tech floats, and I think that's telling. Most importantly, though, what we've got is a situation where we know that the result of quantitative easing exists because interest rates were pushed down to zero, and it didn't have any effect on consumption because people were already geared too high, corporates and individual consumers. So now we're in a situation where we've got a very real risk that, they're talking about helicopter money now, the idea that you just hand governments money so that they can afford tax cuts or infrastructure spending. That worked in Australia, by the way, during the GFC. We had the school building program and everyone just got handed cash.
It's our fiscal policy.
It worked. But governments can't afford it because they're so indebted already. So that's the tension. That's the tension. That's the tension. For governments to make that decision.
I laugh at the word "can't afford it." It's a bit like, I think today all the coalition ministers were saying we have to live within our means.
Yes. Thanks very much.
Yes, right.
Yeah, indeed.
Indeed.
So all of those things. So pulling that all together, the risk, and this is not to say it's to occur, but the risk is that if the economy slows down to the point where we would describe it as a recession, if it did,
Australia or
globally, particularly the US, but globally, if that happened, then there's no bullets in the barrel, so to speak, to fire at it because interest rates are already at zero. And that Janet Yellen spoke about that in her most recent speech, that's the very great concern. And I'm concerned that what we've seen is we've seen an expansion in the PE ratio since the recent lows. You know, we've seen a 13% rally since the bottom for the S&P 500. We've seen it rally, but at the same time, over the last 2 years, we've seen earnings, S&P 500 earnings drop from $105 to about $84. So that's a substantial decline, and yet we've had a rally in prices.
Is there any exchange rate effect in that calculation?
No, that's all US. That's just staying in the US.
Okay.
They're the things that I'm concerned about. And your next question will probably be, well, is there any, is there a silver lining in all of this? No, and there is.
Yeah, okay, we'll go.
Well, there absolutely is. Yeah. So in Australia, for example, I think it's more important in a low return environment, which is absolutely what we're in right now.
Yep.
A return where and that's the result of asset prices being pushed up, and that higher asset price not being supported by earnings growth. Why isn't it being supported by earnings growth? Because, as we heard from Tony just a moment ago, companies have upped the dividend payout ratio, so there's less capital being retained to grow. And so as a result,
they're not investing with it.
They're not reinvesting, exactly. And that's a problem for Australia as an economy anyway. So we've got asset prices going up. We know why I've just described why they've gone up.
Yeah.
Asset prices have gone up, not supported by earnings growth, and so there's a concern that it could all mean revert. So the silver lining in this low return environment is buying businesses that can grow. That's the bottom line. You have to buy businesses that are able to grow their earnings, and there are a bunch that are doing that and are still cheap.
They're telling me we're running out of time.
Sure.
Give me two good ones.
Okay, so a couple of good ones. REA Group. Believe it or not, if you believe that
popular again, it was unpopular for a while. It's back in popular.
Look, it's probably 13 or 14% below what we think it's actually worth.
Yep.
And the reason why we think it's good is because its revenue is a function of the number of listings multiplied by the period of time they're listed. In a boom property market, properties sell without even being listed. Yep. So you're going to have more listing in a high pressure market, and they're going to be listed for longer because it takes longer to sell.
The housing boom coming off the board is going to be good for REA, not worse.
Good for REA's revenues. Next one. And the other one, iSentia, which is the old Media Monitors business. You would be very familiar with that business.
I put our people on a couple of months ago.
Right, so
6 months ago.
So iSentia is a business we've owned for a long time.
Still good.
And we still think it's about 20 to 25% below our estimate of its value.
Well, Roger, they haven't told me we have to wind up, so we won't.
Oh, okay, good.
One last question then.
Yes.
Is there a company... I want you to give me your ANZ view. What's going to happen with ANZ?
Look, we don't own ANZ. We did own it. We sold it some time ago. In this sell-off, we've recently bought CBA and Westpac.
You recently bought with the price going for
We don't think they're bargains, by the way, as Tony agreed. We think they're cheap, but they're not bargains.
Okay investments.
They're okay investments. And look, the reality is the population will be significantly larger in 20, 30, 40 years' time.
That's right.
And on an island, banks aren't bad businesses to own.
No.
And so we believe that there'll be some pressure on their net interest margin. We think that, unfortunately, they're writing back of provisions for bad and doubtful debts, which boosted the profits over the last few years. That's going to come home to roost, so they'll be under some pressure, which is why we've seen the share price fall. We also think their ROE is under pressure because they've had to up their equity capital, their CET1 ratio, and their mortgage risk weighting ratios have gone up as well, so they can't lend as much for every dollar.
Bottom line,
Bottom line, look, I'll say this. I think they're cheap, they're not bargains. The share price could go lower, though. I guess that's what I'm saying.
Yeah, but if you're a long-term holder and you just want dividends, you believe that dividends are reasonably sustainable.
But Peter, 6% dividend or a 7% dividend, if you're losing 30% of your capital, is not that good.
But if your capital comes back over that time, you don't care.
Okay.
We'll talk about that later.
All right.
All right. We'll have an argument on that one night.
All right.
All right, great stuff. That's Roger Montgomery, as always, being unique. Coming up after the break, we'll talk to the founder of a company called Redbubble.